joining us. So in this video, we are going to be covering the top 5 mistakes that beginners make when they first start trading. So you may have seen the stats that 60 to 90% of traders lose money when they trade. And there are a number of reasons why this is the case. The first mistake that many beginners make is that they choose the wrong broker. Of course, when you first start in the Forex trading game, it's very difficult to decide which broker is going to be trustworthy, which brokers are going to treat you fairly and provide good, secure trading environments. So if you choose a broker that is unregulated or has very poor regulation, you are vulnerable to scams, and then you may not have mechanisms for sorting out disputes, especially if the regulator is not a local regulator in your country. So that is something to really look out for. And the other thing is, if you are trading with a broker that is not very well regulated, you may not have mechanisms like negative balance protection, which means that you can actually lose more than your initial deposit. So this is a very important point and something that you should be aware of when you choose a broker. So the next mistake that beginners make when they choose a broker is that they choose a broker with a very high minimum deposit requirement. So we always suggest choosing a broker with minimum deposit requirement of $100 or less. This means that you don't risk losing so much money when you first start trading. Secondly, we suggest choosing a broker that has reasonable trading costs. So we always publish the trading costs of our brokers on our website. And generally, brokers charge trading costs either through a spread or a commission, depending on their execution or what type of broker they are. And spreads of sort of 1 pip or less are reasonable spreads for the Euro USD, and commissions of between sort of 7 and up to 10 USD per trade are reasonable commissions. So always check those trading costs before you start trading. Otherwise, it's going to be very difficult to be profitable. Then brokers don't always offer demo accounts that don't expire. So sometimes they have a time frame. They allow you to trade on their demo accounts for 30 days. And this obviously brings up other issues where you're not able to test your trading strategies. You're not able to get a good feel for their platforms. So we always suggest choosing a broker that has a demo account that doesn't expire. And lastly, you must look at brokers, especially when you first start trading, that have platforms that are user-friendly and intuitive, and maybe even that have a platform walkthrough. So you know how to execute your trades, get out of your trades, which are obviously very important to prevent you from losing money. And this brings us neatly to mistake number 3. So the third mistake a lot of beginners make is that they don't practice on a demo account for long enough. Now, demo accounts are obviously not as emotionally charged in terms of trading because you're not using real money. So you don't sort of get that feel on the demo account. But what it does afford you is it gives you the opportunity to practice on the platform. And as I mentioned earlier, that's very important if you need to be able to get into and out of trades. And a demo account also allows you to practice your trading strategy. So it allows you to see if the strategy you are using works and whether your risk management strategy works. So demo accounts are absolutely imperative, and we suggest using a demo account until you can see that your strategy works and that you are familiar with the platform, and that you get a real feel for the market conditions. So the fourth mistake that many beginners make is that they trade emotionally. And this means trading out of fear or trading out of greed. When you trade out of fear, you fear losses, and it often results in missed opportunities with trading. And when you trade out of greed, you are trading to gain more wins than is prudent. So you begin over trading. Emotional trading often results in losses because you are not taking control of your emotions, because you often don't follow a trading strategy, because you also don't follow your risk management rules. So in order to overcome emotional trading, we always suggest following a trading strategy and being disciplined to stick to it. And the last mistake that many traders make is that they don't come up with a risk management strategy. So they don't create rules for when they exit trades and when they enter trades, and which means they don't set stop losses and take profits. And they often don't have a rule for how much capital they're willing to risk on a day. So a lot of professional traders or more experienced traders talk about risking only 2% of your capital on any given trade and not more than 5% of your capital for any trading day. And if you can stick to your risk management rules, you will likely find that you will be successful with your trading and that you will create scenarios where it will give you a higher ratio of wins to losses. Thanks for tuning in today. We hope that these rules have helped you. If you're a beginner trader, you can go to our website and see all the other resources we have for beginner traders. And if you have any questions, please don't hesitate to reach out to us at podcast@fxscouts.com. Cheers.